Hello students and welcome back to BankExamsToday.com. My name is Ramandeep Singh and today we are going to discuss SEBI's categorization of mutual fund schemes. Students, we have started Bank of Baroda Relationship Manager course on BankExamsToday.com in which we are covering the entire syllabus with the help of video classes, notes, quizzes and the test series. A link to join the course is available in the description. A list of our successful students in the past. All these students that took our courses in the past and they cracked their respective exams. So we are going to discuss various kinds of mutual funds. So as per SEBI's guidelines, there are 5 kinds of mutual fund schemes: equity schemes, debt schemes, hybrid schemes, solution oriented schemes, and then other schemes are there. So we are going to discuss all 5 of them, and let's start with the equity schemes. So as the name suggests, the equity schemes primarily invest in equity and equity related instruments. The investor's money is invested in equity and equity related instruments. The goal is to generate long-term wealth, right? Seek long-term growth. And it is suitable for investors with higher risk appetite and longer investment horizon. So we are going to discuss the various kinds of equity funds. The first one is the multi-cap fund. So what is a multi-cap fund? In multi-cap fund, at least 25% of AUM should be invested in large cap, another 25% in mid cap, and another 25 in small cap companies. So 25, 25, 25, and rest can be invested according to the wish or according to the belief of the fund manager. Flexi cap fund. In this kind of fund, at least 65% of investment should be in equity or equity related instruments in whichever kind of company he wants to invest. The fund manager can invest in large cap, mid cap or small cap companies, but at least 65% should be in equity. In case of large cap funds, at least 80% of the investment should be in large cap stocks. Large cap stocks means what are large cap stocks? So according to the market capitalization, top 100 companies listed in the stock exchange, in the national stock exchange, they are termed as large cap companies. So 80% of the money should be invested in the large cap companies. Large and mid cap funds, in this kind of funds, at least 35% of the investment of the AUM, asset under management, should be invested in large cap and another 35% in mid cap. Okay. Top 100 companies are known as large cap. Top 100 companies are known as large cap. From 101 to 250, they are mid cap, right? And beyond that, these are small cap companies. Okay. So mid cap fund, at least 65% of the investment should be in the mid cap stocks. And in the small cap funds, at least 65% of the investment should be in small cap funds. So what is a dividend yield funds? Some of the companies, for example, Hindustan Unilever Limited or HCL, these companies are popular in giving higher amount of dividends, right? So these kind of funds, they predominantly invest in the companies which, give more amount of dividend, right? At least 65% in such stocks. So example is HUL or HCL. Generally, they give like 4-5% of dividend, which is very high as compared to the competitors. Value fund. So the value funds, they follow the value investment strategy with at least 60% in these kind of stocks. What is value investment strategy? So picking the stock which is available at a low price as compared to its actual value, it is available at a lower price. For example, Asian Paints right now is available at, I guess, 2200-2300 rupees, but the fund manager may feel it is available at a discount. So fund manager is picking the stocks which are available at a perceived discount. Then what are contra funds? So the contra schemes, they follow a contrarian approach. or a contrarian investment strategy. So what do you mean by contrarian investment strategy? You are going against the flow. So some of the stocks are there in the market, which market is not supporting right now. The market is not in favor of paint stocks right now. Right now, market isn't in favor of Asian paints. Market is going against Asian paints. In general, market is not in favor of IT companies in India because of AI. I mean, there is a danger of fall of business in case of IT companies. That is why the markets are not markets, and the investors in general are not favoring IT companies. That is why they are available at a discount, right? So under the contrarian approach, the fund manager is going to buy the companies like Asian Paints or maybe TCS, right? So at least 60% should be invested in such stocks, right? Focused fund. So in the generally in the funds, in the flexi cap funds, large and mid cap funds, there are like 60, 70, 100, even 150 stocks are there, right? So these fund manager, because nowadays the funds are very, very large, right? It's very common to see like a 20,000, 30,000 crore rupee fund. So there are a lot of companies which are part of the fund. Under the focused approach, maximum number of stocks that the fund manager can hold in the particular scheme is 30. At max, 30 stocks can be there in the portfolio, with at least 65% in equity or equity related instruments. What is thematic or sectoral fund? At least 80% of the stock in a particular sector or the theme. So what kind of sector I'm talking about? Maybe there is very common IT sector funds are there, banking sector funds are there. So at least 80%. If it is an IT fund, 80% of the money should be invested in the IT stocks. Then what is ELSS? Now, then thematic. I forgot about thematic. I told you about sectoral, then thematic. So thematic can be infrastructure theme can be there. So when we talk about infrastructure, if we talk about infra, so cement companies are there, right? Cement companies are there. Even the steel companies would be part of it. Steel, cement, whatever is part of, even I would say paint companies, chemicals, all are part of it. When it comes to like EV is also a theme. When it comes to EV, battery companies are part of the theme. The automobile, the car companies, automobile, two-wheeler, three-wheeler, then the tire companies, all these are part of it, right? So that's the thematic fund. What do you mean by ELSS? At least 80% of the stocks in accordance with equity linked saving scheme notified by Ministry of Finance. So if you want tax deduction under section 80C, you need to have a lock-in period. You need to have a lock-in period. In this kind of scheme, there is a lock-in period of 3 years, and at least 80% of the money should be invested in stocks, Indian stocks. At least 80% of the money should be invested in Indian companies, and there is a lock-in period of 3 years. Okay. So let's move forward to the sector specific funds, as I have already discussed. So the money is invested in a specific sector. It can be IT, banking, etc. Pharma, healthcare, banking, FMCG, like that. Thematic fund, I have already discussed with you. There can be a infrastructure based fund, service sector, service industries, PSUs, MNCs, EVs, it can be there. So what are the debt schemes? That's the next part. Debt scheme is also known as a fund that invests primarily in bonds or other debt securities. Debt funds invest in short and long-term securities issued by government, public financial institutions, and the companies and banks, right? So what kind of securities that these schemes they invest in? These are treasury bills, government securities, debentures, commercial papers, certificate of deposits, etc. So we are going to discuss the various kinds. Let's move to the next slide to understand these various terms: short term, medium term, long term, gilt fund, treasury funds. So here we have this. What is an overnight fund? Overnight securities have maturity of 1 day only. So overnight securities have maturity of 1 day. Liquid funds, they have maturity up to 91 days. Ultra short duration funds, they have maturity between 3 months to 6 months. Low duration funds, they have maturity from 6 months to 12 months. Money market funds, they have maturity up to 1 year. The short duration funds, they invest in debt and money market instruments, and their duration of the portfolio is generally between 1 to 3 years. Medium duration funds, the maturity or the duration of the portfolio is between 3 to 4 years. And then the medium to long duration funds, the duration is between 4 to 7 years. And the long duration funds, where the duration, Macala duration, is more than 7 years. So what is a dynamic bond? So under the dynamic bond, the money is invested across various durations. It can be in the short duration, part of the money can be invested in short duration bonds. Some of the money can be invested in long duration bonds. So that's a dynamic bond. Corporate bond fund invest at least 80% of the money in the corporate bonds with only credit rating of AA plus, right? Credit risk fund, where at least 65% of the money is invested in corporate bonds, where credit rating is AA and below. So why people invest in credit risk fund? To make more money. The rate of return is generally higher, but the risk is also very high. Banking and PSU fund. So in the banking and PSU fund, minimum 80% in debt instruments of banks, public sector undertakings, and public financial institution and municipal bonds. At least 80% is invested in these kinds of assets. In the gilt funds, minimum 80% in the government securities across maturity is invested. Gilt funds means the money is invested in government securities. Gilt fund with the 10-year constant duration, minimum 80% in government securities, such as with the duration of 10 years, right? Floater fund. I hope you are aware of floating rate of interest. Under the floater fund, at least 65% of the money of the AUM, asset under management, is invested in floating rate instrument where the rate of interest moves, right? So dynamic bond funds alter the tenure of the securities in the portfolio. Obviously, the tenure changes for various securities in the portfolio. In the floating rate funds, they invest in bonds where interest rates are reset periodically, right? And the amount of money that you earn or the NAV changes according to the reset of the rate of interest. What are fixed to maturity plans? As the name suggests, your money is locked in, right? They are not, they are actually popular, right? But they are not very beneficial to the customers because, the banks, they sell these fixed maturity plans and people, they'll end up losing a lot of money. You should be aware of it. So these are closed-ended funds, which eliminates interest rate risk, but the commissions are really higher in these kind of funds. And there is a lock-in period, right? So it creates an investment portfolio where maturity profile matches that of tenure of the fixed maturity plans. So you get an opportunity to make a stable rate of interest. Okay. Then what are hybrid funds? So hybrid fund, it's a mix of equities and debt securities. So there are 7 categories of hybrid funds. The first one, the conservative hybrid funds. 10 to 25% of the investment should be in equity and equity related instruments and 75 to 90% in debt instruments, right? So it is a conservative hybrid fund. In the balanced hybrid fund, 40 to 60% in equity, 40 to 60% in debt instruments. In the aggressive hybrid funds, 65 to 80% in the equity related instruments and 20 to 35 in debt instruments. In the dynamic asset allocation or balanced advantage fund, investment or debt is managed dynamically, right? So 0% to 100% in equity or equity related instruments and 0 to 100% debt related instruments. So it is dynamic asset allocation. Multi-asset allocation, the investment should be in at least three asset classes. So equity is one asset class, then there is debt, then there is gold, then there is AIFs, then there is, REITs, right? With a minimum allocation of at least 10% in each asset class, right? What is an arbitrage fund? So arbitrage fund, the scheme follows arbitrage strategy with minimum investment of at least 60% in equity related instruments. So they are not holding any stock for a long period of time. What they are trying to do is they are trying to buy stocks from one market and trying to sell it in another market, or they are trying to sell it very quickly to make quick money. Equity savings, equity minimum 65% should be investment should be in equity and equity related instruments, 10% in debt, and some of this investment in the derivatives, right, for hedging purposes. Then there are solution oriented funds. There is a retirement fund. In the retirement fund, there is a lock in period of at least 5 years or retirement age, whichever is earlier. In the children fund, lock-in period is 5 years or till the child attains the majority, 18 years of age, whichever is earlier. In the index funds, minimum 95% investments in securities of a particular index. That can be Nifty 50, Sensex, right? So 95% of the money should be invested in the index. Funds of fund, 95% investment in the underlying fund. So what the fund manager is doing, the fund manager is investing in multiple funds, multiple other funds, right? So maybe there is for 1, 2, 3, 4, 5 funds. What the fund manager is doing, the fund manager is investing money in all these funds, right? So what are the index funds? Index fund is trying to mirror a market index. So maybe they are trying to copy the Nifty 50. There is a UTI Nifty 50 fund. So the expense ratio is actually very low, and that fund is trying to mirror the Nifty 50, right? They're trying to match the returns of Nifty 50. The fee is generally very low. Fee is generally 0.2%, 0.1%. That's the kind of fee that you pay. What are ETFs? So ETF, it's a marketable security that tracks an index, right? So for example, for Nifty 50, there is an ETF, right? So all the constituents of Nifty, they are pooled by, let's say, UTI or let's say by Nippo, right? And this is traded as a security in the stock market, right? Now people are going to buy and sell this bundle of, or this pool of stocks, right? So an ETF is a marketable security that tracks an index, commodity, bonds, basket of assets like an index fund, right? So it's similar to index fund. The expense ratio is even lower than the index fund. But what is the benefit of an ETF over an index fund? The processing time. You can buy or sell ETFs in real time, but in case of index fund, there is cutoff period. You sell it today, obviously, the settlement would be done tomorrow, right? It's like that. But ETFs, it's real time, and the ETFs would be shown on your demat account. All your ETFs holding would be on your demat account, right? So gold exchange traded funds. So gold ETFs, they are backed by gold as an underlying assets. So the scheme will issue units against gold held, right? And obviously you can trade it on the stock exchanges. It will show in your demat account. Okay. The scheme can invest up to 20% of the net asset in gold deposit schemes of the banks, right? So what are international funds? So you can also invest your money in the international funds. For example, the ICICI has one. ICICI Nasdaq fund is there. So they are trying to, there can be international index funds, or, there are funds of funds. Some of the funds are there. Invesco has an international fund. Lot many AMCs having international funds. So international funds enables investment in the market outside India. You can invest your money in Google, Facebook, Meta, right? So your money is invested in equities of companies listed abroad, ADR and GDR of Indian companies, debt companies listed abroad, ETFs of other countries, units of passive index funds in other countries, or units of actively managed mutual funds in other countries. So that's all about it. If there is any doubt in your mind, please ask your doubts and we are going to answer all your doubts. So that's all for today, students. Thank you and have a very nice day. Bye-bye.